Good day everyone, I am Rasmia Bandila, one of the reporters from Group 9, and this is the continuation of Johanna Amin's report. So, we are done with the liquidity ratio where we provide different ratio formulas to calculate the ability of a company or business to pay its short-term obligations. Let's proceed now to the profitability ratio. Ratios under this category are number 1, gross profit. With the formula, gross profit margin is equal to gross profit divided by net sales. Number 2, profit margin. With the formula, profit margin is equal to profit divided by net sales. Number 3, return on total assets. With the formula, return on total assets is equal to profit divided by the average total assets. Number 4, return on equity. With its formula, return on equity is equal to profit divided by average equity. And the last one, assets turnover. With the formula, assets turnover is equal to net sales provided by average total assets. Gross profit margin. This is where we measure how much of every peso earned from sales is left after covering the cost of goods sold. Dito natin malalaman kung gaano ka-efficient ang isang business sa pag-produce and pagbenta ng kanyang products. Let's use the brewed daily coffee again as an example. Let's say in 1 month, they have the following sales activity. They have a net sales of 150,000 pesos with a cost of goods sold of 90,000 pesos. To get the gross profit, we have to deduct the 90,000 pesos cost of goods sold to the 150,000 pesos net sales with the difference of 60,000 pesos. To get the gross profit margin, we have to divide the 60,000 pesos profit to the 150,000 pesos net sales, which we got 0.4 or 40%. A higher margin means more profit per sale, and a lower margin might mean high cost or pricing issues. This means that for every 1 peso earned from Brewed Daily Cafe, they keep 0.4 gross profit before deducting other expenses. Profit margin. On this part, we are not just focusing on the cost of the goods sold, we are taking note how much actual profit a business earns for every peso of sales after costs like rent, salaries, supplies, and others. Let's use the Brewed Daily Cafe as an example and assume that in 1 month, they have a net sales of 150,000 pesos with the cost of goods sold of 90,000 pesos and operating expenses of 50,000 pesos. To get the profit, we have to deduct the cost of goods sold and operating expenses from the net sales, and we got a difference of 10,000 pesos. To get the profit margin, we have to divide the 10,000 pesos profit to the 150,000 pesos net sales, which we got 0.067 or 6.7%. A higher profit margin means the business keeps more of its sales revenue as profit, while lower profit margin could mean expenses are too high or pricing might need adjustment. Return on total assets. On this ratio, dito natin makikita how efficiently a business uses its total assets like equipments, cash, and others to generate profit. It shows how much profit is made for every peso invested in assets. Let's use the Brew Daily Coffee as an example. Let's say for the year they have a profit of 50,000 pesos, total assets at the beginning of the year of 400,000 pesos, and total assets at the end of the year at 600,000 pesos. To get the average total assets, we have to sum up all the assets from the beginning to the end of the year and divide them into 2, which we got 500,000 pesos. To get the return on total assets, we have to apply the formula where we have to divide the 50,000 pesos profit to the 500,000 pesos average total assets which is equal to 0.10 or 10%. It was said that if return on total assets is high, it means that business is managing its resources well to generate income. If it's low, the company might have too many idle or unproductive assets. In the case of Brewed Daily Coffee, they earn 0.10 of profit for every peso it has invested in assets. That's 10% return, meaning their assets are being used efficiently to generate income. Return on equity. This ratio measures how well a business uses the money that owners invest to generate profit. Meaning, kung sa bawat piso ng equity, magkano ang profit na nag-generate ng business. To get this, we have to use the return on equity formula. Let's use the Brewed Daily Coffee as an example. Let's say they have a total equity at the beginning of the year of 200,000 pesos and a total equity at the end of the year of 300,000 pesos. Let's also assume na they have a net profit of 75,000 pesos. First, we have to compute the average equity. And to get that, we have to get the sum of equity at the end and beginning of the year and divide it into 2, which we got 250,000 pesos. To get the return on equity, we have to divide the 75,000 pesos profit to the 250,000 pesos average equity. If return on equity is high, it means that business is using the owner's money efficiently to generate profit. If return on equity is low, it suggests the business might not be generating enough income from the owner's investment. In the case of Brew Daily Cafe, they earn 0.3% for every 1 peso na investment ng owner of or shareholders. Ibig sabihin, the business is generating 30% return on the owner's equity. Assets turnover. Para lang siyang return on total assets kasi pareho naman silang related sa kung paano ginagamit ng business ang assets nito. Ang kaibahan nila is ang return on total assets is nakafocus sa paggamit ng assets to generate profit, not just sales. Assets turnover, on the other hand, is used to assess how efficient a business uses its assets to generate sales revenue. Let's use the Brew Daily Cafe. Let's assume they have a net sales of 300,000 pesos, total assets at the beginning of the year of 400,000 pesos, and total assets at the end of the year of 600,000 pesos. Let's compute the average total assets by adding the assets at the end and beginning of the year and divide it into 2, which we got 500,000 pesos. To get the assets turnover, we have to divide the net sales of 300,000 pesos to the average total assets of 500,000 pesos, which we got 0.6. A higher asset turnover means the business is using its assets efficiently to generate the revenue, while lower turnover may indicate that business has underutilized or too much unused equipment, inventory, or assets. Ideally, it should be one or more. So, in the case of Brew Daily Cafe, they might not be using their assets to their full potential. So, now, we are done with the profitability ratios where we provided different formulas for different situations where we want to measure the health of the conditions and profitability of a business. Let's now proceed to solvency ratios. Under these ratios include number 1, debt to total assets with the formula. Debt to total assets is equal to total liabilities divided by average total assets. Number 2, debt to equity with the formula. Debt to equity is equal to total liabilities divided by the average total equity. And the last one, times interest earned with the formula. Times interest earned is equal to earnings before interest, expenses, and taxes divided by interest expense. Debt to total assets. Pinapakita dito yung percentage of a business assets that are financed by debt or by creditors. This shows how much of a business resources are funded through borrowing. Let's use the Brew Daily Cafe as an example. Let's assume that they have a total liabilities of 200,000 pesos, beginning total assets of 400,000 pesos, and ending total assets of 600,000 pesos. Let's compute the average total assets by combining the beginning and ending total assets and divide it into 2, which we got 500,000 pesos average total assets. To get the debt to total assets, we have to divide the 200,000 pesos liabilities to the 500,000 pesos average total assets, which is equals to 0.4 or 40%. A high ratio of 0.5 or 50% means more than half of the company's assets are financed by creditors and could be very risky if the company struggles to pay debts. A low ratio suggests the company relies more on its own equity than on borrowed funds. In the case of Brew Daily Coffee, 40% of their total assets are financed by creditors, while the remaining 60% came from the owner's investment of their earnings. Debt to equity. This is where we measure the level of borrowing compared to the owner's equity. This ratio tells us how much debt a business is using for every piece of equity provided by the owner. Let's use the Brew Daily Cafe as an example. Let's say they have a liability of 200,000 pesos, beginning equity of 200,000 pesos and ending equity of 300,000 pesos. First, we must compute the average equity by combining the beginning and ending equity and dividing into 2 to get the debt to equity. We have to divide the 200,000 pesos liabilities to the 250,000 pesos average equity, which we got 0.8. A high ratio means the business relies heavily on borrowed money, while low ratio means the business is mostly funded by the owner's capital. In the case of Brew Daily Cafe, they have debt to equity ratio of 0.8, which means they borrowed 0.80 pesos for every 1 peso of owner's capital. Times interest earned. Minimeasure dito yung ability ng business to pay its interest expenses with its operating income before tax and interest are deducted. Let's say the Brew Daily Cafe have earnings before interest and taxes of 90,000 pesos and they have interest expense of 15,000 pesos. To get the time interest earned, we have to divide the 90,000 pesos earnings before interest and taxes to the 15,000 pesos interest expenses, which we got 6. A higher ratio means the business has a stronger ability to cover its interest payments, while low ratios, especially below 1.5, could signal financial stress. In the case of Brew Daily Cafe, meron silang earnings na 6 times more than what it needed to pay in interest each period. So, we are done with the solvency ratio, where we introduce ratios that would measure the ability of a business to pay its long-term obligations. Let's now proceed to the last one. The activity ratio, which includes accounts receivable turnover with the formula. Accounts receivable turnover is equal to net credit sales divided by average accounts receivable, number 2, average collection period. With the formula, average collection period is equal to 365 days divided by the accounts receivable turnover. Number 3, inventory turnover with the formula. Inventory turnover is equal to cost of goods sold divided by the average inventory. And the last one, average days in inventory. With the formula, average days in inventory is equal to 365 days divided by inventory turnover. Accounts receivable turnover. This ratio tells us how many times the company collects its average receivable annually. It measures the liquidity of receivables or how quickly a business collects money from credit customers. Let's use Brew Daily Coffee as an example. Let's say meron silang net credit sales of 240,000 pesos, beginning accounts receivable of 30,000 pesos, and ending accounts receivable of 50,000 pesos. To get the average accounts receivable, we have to get the sum of ending and beginning accounts receivable, which we got 40,000 pesos. To get the accounts receivable turnover, we have to divide the 240,000 pesos net credit sales to the 40,000 pesos average accounts receivable. A higher ratio means customers are paying on time and the business is collecting cash quickly, while lower ratio may suggest poor collection practices, slow paying customers, or too much credit extended. In the case of Brew Daily Coffee, they collect average receivable 6 times annually or about once every 2 months. Average collection period. This shows how many days on average it takes a business to collect payments from its credit customers. This ratio tells us how quickly a company turns its credit sales into cash. It complements the accounts receivable turnover ratio by expressing it in terms of days. Let's use Brew Daily Cafe as an example, assuming they have net credit sales of 240,000 pesos, average accounts receivable of 40,000 pesos, and an average receivable turnover of 6. Based on the previous example, let's apply the formula. To get the average collection period, we have to divide 365 days to the accounts receivable turnover of 6, which we got 60.83 days. A shorter collection period means the business is collecting payments quickly, while longer collection period may indicate slow paying customers or weak credit control. In the case of Brew Daily Coffee takes about 61 days on average to collect payments from its credit customers. Inventory turnover. It measures how quickly inventory is sold and replaced during a specific period, usually a year. In this ratio, dito natin malalaman kung ilang beses nabebenta and nare-replace ng isang business ang kanilang inventory. Let's use the Brew Daily Cafe as an example. Let's say their cost of goods sold is 360,000 pesos. Their beginning inventory is 40,000 pesos and their ending inventory is 20,000 pesos. We have to compute the average inventory where we have to add the beginning and ending inventory to have 30,000 pesos average inventory. To get the inventory turnover, we have to divide the 360,000 pesos cost of goods sold to the 30,000 pesos average inventory, which we got 12 point. A higher inventory turnover means strong sales or good inventory control. A low turnover may suggest overstocking, outdated products, or slow-moving items. In the case of Brew Daily Coffee, they sold or replaced their inventory 12 times during the year or about once a month. Average days in inventory. Pinapakita dito how many days inventory stays on hand bago siya nabibenta. Dito natin malalaman ang liquidity and efficiency ng inventory or how fast it moves. let's use the Brew Daily Cafe as an example. Based on the previous example, they have inventory turnover of 12. To get the average days in inventory, we have to divide the 365 days to the 12 inventory turnover, which we got 30.42 days. A shorter number of days means efficient inventory management, while a longer number of days may indicate slow moving inventory or overstocking. In the case of Brew Daily Coffee, they hold their inventory for about 30 days before selling it, which shows na maganda ang pag-manage nila sa inventory nila.